What's up, Gould Miners? Today, we welcome to the program Ladislas Maurice, aka the Wandering Investor. After leaving his corporate job at the age of 30, Ladislas decided to dive headfirst into international investing and has since become one of the foremost experts in international investment strategies. And today, he shares some of his knowledge and wisdom with you. We start off the episode by discussing foreign investments and how powerful they can be as a diversification method. Later on in the episode, we discuss what Ladislas refers to as a super inflationary global period and the hedging strategies that Ladislas is currently recommending to those who are looking to stave off global inflation. And finally, we dive into a very fascinating topic, which are the benefits of investing internationally outside of just returns. Things like international residency programs, access to foreign banks, and even citizenship in some countries for you and future generations of your family. This episode is truly a game changer when it comes to opening and expanding your mind to the possibilities outside of what currently exists in your own little bubble here in the United States. So if you're brand new to investing, or especially if you're a seasoned investor, this is a powerful episode that really will hopefully expand your horizons and get you thinking in ways outside of the traditional investing norm here in the United States. So without further ado, everyone, let's welcome to the program Ladislas Maurice.
The Gould Mine Podcast.
Ladislas, welcome to the Gould Mine.
Thank you.
Awesome, man. I'm super excited to have you on, and you know, the things that you're doing right now, a lot of the topics that you're an expert on, they're really not talked about a lot in the States. And so I think that there's going to be some revolutionary kind of concepts here that are introduced to the majority of the audience. And before we get into that, though, and before we get into like the meat and potatoes of it all, why don't we start with what got you to this point, right? So you were in corporate, you were working corporate
Correct.
job, and at some point you decided, why don't I just not do that and get into investments? And so what drew you to international real estate investing, and what was it that got you out of that corporate like 9-to-5 kind of grind into this like newer or it is more like novel kind of real estate investing?
Yeah, all the whole emerging market real estate stuff. So essentially, I grew up as a child, just going around because my father was a university professor and he'd get contracts in different countries. And so I went to school in a lot of different countries. So as a child, I was just used to bounce from school to school, from country to country, different school system to different school system. And at the age of 18, I just went on and did I did my bachelor's degree in Canada. Then I went to business and law school in Australia. And then I got into a whole corporate career, but obviously it had to be an expatriate career. So I started in Switzerland for Nestle, the big food company. And then they sent me over to Africa for 7 years. So I spent most of my 20s in corporate in Africa. So first being in charge of marketing for ice cream in Southern Africa, and then sitting on the board of Nestle Ghana, being in charge of the milk business for a few West African countries. So my 20s were pretty unique, if I can put it this way. And then at the age of 30, I thought, cool, I've spent most of my 20s in Africa. I don't necessarily want to be the Africa specialist, right? Because after a while, if you stay too long in a certain geography, you become the guy for that. So I was like, cool, let me just, go for something else. So I left, and my plan was initially to go to move to Dubai and get a job there. But before doing this, I was like, oh, let me go travel for a little bit, right? So I took a car, and we drove with my family. We drove from Oman in the Middle East near the UAE to Paris by car. So we, drove to Dubai, and then we put the car on a ferry. We crossed over to Iran. We drove all over Iran, into Armenia, Georgia, crossed all of Turkey, went into Greece, up to Ukraine, and then drove to Paris from there. And then it was the first time in my life that I had two things at the same time, which are time and money, right? Because when you're young, you have time. You don't have money.
Yeah.
And then later on you have money, but you have no time. For the first time, I had like a bunch of savings. I had already made a few international real estate investments when I was working full time at Nestle. And I just found myself in these countries with time, just walking around these beautiful cities, historical cities, checking out real estate, meeting up with lawyers, and just seeing that, the valuations were quite interesting. So I started doing flips. So I started buying apartments, renovating, and then selling, and thinking, okay, after this flip, I'll look for a job in Dubai. And then I never looked for a job in Dubai. So now it's been a number of years, quite a few years actually. And I'm doing this full time. And then my friends, after a while, when Facebook was still a thing, and we're like, Ladislas, you're always like in these weird countries traveling and you don't seem to have a job anymore. What do you do? And that's when I just like, let me just create a blog for fun, just to document what it is I do. And then the blog snowballed into, the Wandering Investor. And now it is what it is.
That's awesome, man. So it's interesting, right? So the first time that you had money and time, you realize, hey, there could be an alternate path for me here, right?
Yeah.
And so that makes a lot of sense.
Exactly. Because once you reach a certain number, right, you work full time, and you save some money, and you make suboptimal investments with your savings. I mean, when I was working full time, 60, 70 hours a week for Nestle, I made a few investments. Some did well, and others were, when I look back, it's pretty obvious they were not very good investments, but I just didn't have the time to dedicate my time to managing my money.
Right.
So once you reach a certain amount of capital, you look at it objectively and you're like, well, if I can increase from a 5% return a year or, 6% and double that, that kind of covers a lot of the savings I would be making by working full time. And instead I'm managing my own money, I have more control and more time. So that's the active, decision that I made.
That's really interesting. So, and that frame of mind, I think I don't know that I've ever heard anyone put it quite like that. At some point, like the opportunity cost of like working a 9 to 5 and then not having a more active role in like managing your investments. Yeah. Like that, like at some point the tables turn, right? All of a sudden, like that lost opportunity from not actively managing your portfolio is actually more than you're making from your 9 to 5.
Yeah, that you're saving, right? Because when you look at it,
interesting.
Look, I mean, let's say you just have $1 million. All right, let's just give an example for that's pretty,
sure,
not too out there. You have $1 million. You invest it normally, you might get like 6% a year, reasonably. If you start actively managing it and you do a good job by dedicating your mind and your being full-time dedicated to it, you can easily make 12%. Guess what? That's an extra $60,000 a year. You get to live in a, low-cost country instead of being, where that would barely be rent in New York. But guess what? With $60,000, you can live in Eastern Europe like a king, or in Colombia like a king, and still be saving money. So you're saving money. You have more control in your life. You have more free time. And guess what? Life is good. So at the end of the day, that's this sort of decision that people just need to make. It's right there in front of them, actually. Many people can make this decision. There are a lot of people with $1 million in assets that could just make a decision like this, but they don't.
What do you think holds the majority of those people back?
The fear of the unknown, risk, and shame if they fail. And for a lot of people, it's hard to leave a career and a job and a brand name and all of that, to go from, I work in this corporate and I have this role and I'm on the board of this and that, to what do you do? And it's like, I flip real estate.
There's a bit of an identity crisis there, right?
Yeah,
like a shifting in the identity. Yeah. And I've been through that personally before where, I was doing one thing and then, I had 35 people working for me. I was, I had my own company, everything. And then one day just decided to pivot into hotel investing, you completely shift your identity and a lot of people call you crazy. Yeah, I can't tell you, like, and pretty much everyone told me that I was nuts. Only very few friends and family were supportive in that.
Yeah.
So I would 100% agree with you there.
I mean, and you were nuts. You were objectively
100%.
nuts, but a good nuts, but you were nuts.
Yeah. Yeah. No, I don't disagree with you there either. In fact, I wouldn't even use the past tense there. I'd say I am nuts. Yeah. Oh, man. But I agree with you right there. Right? Fear of the unknown, risk, shame. I think the shame of potentially fail, or the shame if you fail, man, I think that's so interesting, right? Because I really do think that fear of failure and like the potential shame of like not succeeding, like, oh, what if I have to go like start from zero, whatever, like I think that holds a lot of people back. I think like that's the number one reason, seriously.
And I'd say that this fear has increased rather than decreased in people with social media, because now running a business and starting something, you just have to be so open about it. It's on everyone's face. It's in everyone's faces. You have to change your LinkedIn and all of that. And if you fail, like literally everyone knows about it. Before, it could be like, oh, what happened to Danny? Oh, Danny, he went over to whatever and opened a hotel in that town, and I think it didn't work out, like whatever. People didn't really know what happened, but now it is in your face. If someone fails, everybody knows.
Yeah. So I mean,
people care less because everyone's involved in everyone's stuff, right? But still, personally, for people, it's a lot harder now to fail, I find.
It's like that scarlet letter, right? But you're just wearing it all day, every day.
Mm-hmm. Yeah. Change of LinkedIn, it's like you're an entrepreneur, blah, 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 running my own show. And then it's like, oh, got a job at like Bank of America.
It's just,
like corporate lending.
Oh, man. Well, it's interesting. So I come from residential real estate background here in the US, and there are so many real estate agents right now, man, because of all the housing bubble here, plus, the interest rates and just like all the economic turmoil, like plus there's like a whole lawsuit. I don't know if you've heard about this, like there's a whole commission lawsuit that's going on right now. So all of those factors combined have made the market incredibly difficult for a lot of agents. And so what you're saying right now, like literally I have like dozens of agents every month I'm seeing on my LinkedIn, like got a job at Bank of America, at Chase, at like all these other, and it's definitely, it can be, if you don't have thick skin, right? And even if you do have thick skin, it's still difficult, anytime that you fail, right? For lack of a better word, there is some shame associated with that. So I think that's very interesting, Ladislas. And to flip that though, if someone were to adopt this strategy, right, and say, hey, I'm going to do it. Let's say that you were starting today, right? What would your first move be? Adopting the strategy that you've now kind of touted out there.
Cool. So I've had a focus on emerging markets, right? If I were American, maybe my strategy would be different. Maybe I'd be looking at US markets because there's leverage, et cetera. It depends. I just like steady, slow growth, which I think is probably due to my professional molding at Nestle, which is always about steady and sustainable growth. So that's how I've approached my investments and as well the way I grow my business. I made the decision to base myself in lower cost emerging markets where I didn't feel any financial pressure whatsoever. And I could live very well and make rational decisions without any financial pressure. So I think that's a mistake that a lot of people make, is they want to start their own business, but they want to keep up appearances. They base themselves in expensive places, and then things just spiral out of control. But when you go to affordable places and you base yourself out of there, and that's where you start your business, you don't have that sort of pressure. That makes a huge difference. And you don't feel the need to compete, right? Because compared to everyone around, you're already well off, right? So it's not like you're trying to like show off or anything. You just focus on yourself.
So don't go live in Manhattan is what you're saying.
Unless your business requires you to. Yeah. Just go somewhere low cost, keep a low profile and just, grind and just go for it. Just accept that the first few years of running your own business will not be glamorous.
Right. Yeah. And I think that's a big reality check for a lot of people. A lot of people want, like when I started my first business, man, I mean, I was living at home with my folks. Right. And like, that's just what it was, So I really do see, and I will say this, like the majority of the people who did not succeed in starting their, like I've seen people who haven't succeeded. It's actually for that exact reason. They didn't have enough runway. It's not that they didn't have it. It's not that they didn't, it's not that they weren't good enough. They weren't skilled enough. They weren't hardworking enough. A lot of times it was just like, I ran out of savings and I need to go make a paycheck right now. And I don't have the ability. So you're 100, like that's a very good, that's a very good suggestion or recommendation. So on top of that though, so when you're talking about emerging markets, we're talking about areas that are high growth, but low profile, right? Like places that people really wouldn't think about necessarily to invest in. So what are the maybe for real estate purposes specifically, because we could talk stock market, right? And emerging markets when it comes to stocks. Let's just focus on real estate for right now. What are the top 3 countries that you are seeing for in terms of emerging real estate markets that are not on people's radar already?
That's a tough question. That's really a tough question. The reality is that nowadays there's nowhere that's absurdly cheap anymore, right? There's no easy money anymore. Governments and central banks have been printing so much money everywhere. The US dollar, the printed money has found its way everywhere in the world. And especially in emerging markets where typically the only savings instrument is real estate, because people often don't think of investing internationally, or there are capital controls for residents, or they don't really trust their banking system. So people just invest in real estate. So whatever money was printed just invariably ends up in real estate. So there's no real estate market now where it's just, it's obvious you're going to do 10x and it's easy and, people are going to come and people are not discussing it, etc. You really have to try to look for very specific, unique situations, but there's no easy money anymore. A few years ago, there was easy money to be made. Now there's no more easy money to be made. They've printed easy money out of existence. Actually, easy money is people who have access to the printer. But for everyone else, it's not that straightforward. So I think I'd say for people who want to invest in international real estate, people just need to be very clear in terms of their objectives. One, it's a long-term play, right? Those are markets, emerging markets, where there's a lot less liquidity. And that's something that North Americans have issues understanding. Buying is easy in emerging markets, selling is hard. So even if you go to a high liquidity market like Istanbul in Turkey, which is, not the capital city, but the economic heart of, the Turkey and 15 million plus people, it's huge. Selling an apartment in a central location will take at least a few months, actually. It will take a few months to sell it at the market price. You go to Budapest, it'll take you a few months as well. You go to Bogota, you go to Medellin, you go to Mexico, selling an apartment will take a few months. And in the US and Canada, we're used to just selling a house in like a week. If it's not going after a week, we start questioning, oh man, did I get my pricing strategy wrong? So it's hard to go into these markets and just make these like quick operations. So it's really more long-term. You go in there for the long-term. If you want like quick, easy money, you stay in North America. That's where the quick, easy money is. It's in North America. It's liquid. It's dynamic. There's always money. People are quick to make decisions. processes are fast. A real estate transaction happens in like a few weeks, boom, done. You got your deed. And some of these emerging markets, getting the title deed might take you 5-6 months sometimes, or sometimes like 2 weeks, 3 weeks, a month. Some markets, it can be a few months. I mean, France is not an emerging market. It'll take like 4 or 5 months for a real estate transaction to go through. So the first thing is people need to manage their expectations. Exactly. Manage their expectations and understand that when you go and invest, you're based in the US, you go invest in international real estate. It's not going to be easy money. The easy money is closer to home. You're doing it for the purpose of diversification, to not be all in the US and to have exposure to completely different economies. That's important. Secondly, a lot of these investments can come with side benefits. So, for example, if you invest $200,000, if you're American or Canadian and you invest $200K in, or make a term deposit of $200K in Panama, you can get residency out of it. That turns into a permanent residency eventually. Right. So then you have the right to live, to work, to bank, everything in a beautiful tax haven, just a short flight away from the US. So if you feel things are not going well in the US, etc., you always have a plan B for yourself. Other countries like Turkey, you put $400K in real estate. Within a year, you get citizenship for you, your wife, or your spouse, and your underage children. That goes down all the generations. So even if your kids have kids, as long as your grandchildren get registered at the Turkish embassy or consulate, they'll get the citizenship, and then it goes down the generation this way. So, and then that's a legacy play, right? You are sitting somewhere in New York or Ohio or wherever it is, or Texas, and you can, by just investing $400K in what is objectively affordable real estate in Turkey, you just need to keep the real estate for 3 years, right? After 3 years, you can sell it, but then you retain that citizenship, your spouse, your children, and then it goes down the generations. Just by making this $400K investment for 3 years, you've made a generational, a true legacy investment. Like your whole lineage will be Turkish citizens. So what will the world look like in 50 years from now, 30 years from now, 70 years from now, 100 years from now? I don't know. You don't know. No one knows. Will Turkey be a better place than it is now? Will Turkey be richer? Will Turkey be a place of opportunity? Will the US be less powerful? Will your great-grandchildren be happy to have Turkish citizenship, to be able to work, live, study, benefit from healthcare in Turkey? Maybe. Right? Yeah. So by just shifting money around in the world, in real estate or in term deposits, you can just accumulate all of these benefits that just go down the generations. So, that's one way as well to look at it. So you've got the potential returns. I've done great with Turkish real estate. I bought a few apartments in Turkey. I get good returns, though actually yesterday, one of my kitchens went on fire, but that's a different topic. Luckily no one was harmed. But yeah, just being clear on one's objective is very important. Some markets have good potential for capital gains on the long run. I can think of Colombia. I can think of Hungary being a good one. Paraguay to some extent, if you play it well. Some markets offer good rental yields. Specific niches in Colombia are pretty good. So you need to be very, very clear in terms of your objectives, because let's be honest with ourselves. When you're investing internationally, it'll be hard for you as a normal American sitting in the US to make a better investment than the average, right? It's like, Danny, where are you based?
I'm based out of the Bay Area, San Jose, California.
Right. So imagine a Colombian comes to the Bay Area, comes for like 1 week and is like, I want to buy an apartment. they're not going to do better than the average market, right? Their best hope is just to get market related, because to get better than average deals, you actually need to spend a lot of time on the ground. But no one's going to go to Colombia for like half a year to try to find like the right apartment. So by default, you need to understand when you're investing internationally, you're trying to aim for market related, because it'll be hard to do much better. It's possible. I'm not saying you won't, but just in your mind, by default, in your expectations, you'll probably just get market related. So just manage your expectations and be very clear with your objectives. I think that would be my main message for people. And then depending on that, there are markets that are more appropriate than others.
You touched on this briefly, and I want to dive into this a little bit more. I know that many investors are looking to optimize their tax strategy through global investments. So how do you structure these international investments to create tax efficiency?
Cool. So I can't speak for U.S. taxes. I'm not a U.S. tax person, and I do not want to learn about U.S. taxes. It's a can of worms I don't want to open. I aim for happiness in life. And the less I deal with the IRS, the less I learn about the IRS, the happier I am. So I'm really sorry, Danny. If you have a Canadian audience, then I could help. We help a lot of Canadians leave Canada, structure things so that they end up paying effectively 0% in taxes, because Canada has a residency-based tax system. So if you become a non-resident of Canada and you move to the right jurisdictions, you can end up not paying any taxes legally. If you're American, different story.
Understood. And so if you can't speak to the U.S.'s specific policies,
generally speaking, I'll just say generally speaking, the way it works for the U.S., not tax advice, generally speaking. Let's say you buy real estate in Colombia, right? You get rental income in Colombia. You'll pay taxes in Colombia on your rental return. And then you should be getting a credit for taxes paid in Colombia when you declare your taxes in the US. But if you invest, for example, in a country that barely taxes anything at all, you'll still have to pay your taxes in the US as an American.
You talked about Panama specifically as a tax haven. What exactly do you mean by that?
It applies less to Americans. A lot less to Americans. For non-Americans, if you move there and you structure things properly, you can end up paying 0% taxes. If you're American, again, you're accountable to the IRS. You have to pay taxes wherever you live. So less of a bonus for Americans. Then again, Trump said that he wants to. That's how they get you. Yeah, that's how they get you. Trump says he wants to remove double taxation for Americans or reduce it, something. Yeah. I don't know. I don't really trust any politician, but if he does
we'll see on November 5th. Yeah.
Yeah. If he does that, that would be really cool for Americans. Then you could, travel and really, reduce your taxes. But yeah, I'm not holding my breath.
Switching gears, when it comes to this idea of inflation being at an all-time high, we've got countries printing money left and right. So what are the hedges against that? I mean, obviously I've heard you talk about precious metals and stuff like that. I know that there's a lot of people who are using crypto as a hedge against, basically any guy, regardless of where you live, right? Against, fiat structure as opposed to crypto. So what are your favorite hedging strategies now that we're very, very obviously in a global inflation, a hyperinflation kind of period, right? And that, of course, there's varying definitions of that, but what you're talking about is very close to a hyperinflationary kind of environment that we're in right now.
Yeah, I mean, we have to take a step back. Hyperinflation is a big word. Mm-hmm. Maybe super inflation is more appropriate. Constant high inflation.
Yep.
Look, the reality is the world is decoupling. Why did we have low inflation for so many years? Because of globalization, because supply chains were being globalized. Everything was efficient. We were integrating with China, just in time all over the world, et cetera, et cetera. And now that we're in a world of conflict, and I'm not seeing any de-escalation, we're seeing de-risking and deglobalization. So naturally, what comes with deglobalization is supply chains that are a lot less efficient. I mean, we can just look at these chips. The government is throwing billions at trying to create chip factories in wherever, Arizona or something in the middle of the desert, where there's no water. But, that's a different topic. That's not efficient. It was just way more efficient to get the Taiwanese to do everything. But because of fear of conflict, because of de-escalation, because of de-risking, because of sanctions, for national security purposes, countries now want to produce more at home, which is a lot less efficient. So this just in itself is very inflationary. And this is just beginning, right? Because CapEx decisions you make a decision now, the CapEx only starts flowing like in 2 years' time after you have all the permits and this and that, blah, 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 blah. So this is only starting. So inflation, I think, is going to increase. Inflation is going to stay with us. So that's my base thesis. And as well, governments are very indebted. How do you reimburse government debt? Guess what? Through inflation. You make sure that inflation is higher than the interest rates that you're paying out to investors. So the last thing I'd be investing in is government bonds. I can tell you that. So what am I doing? I've got gold, obviously. I'm long commodities. I'm also long very cheap emerging market real estate. Like I'll just give you an example. I bought a penthouse in Medellin in Colombia. I ended up paying, after the full renovation, the furniture, everything, about $120 a square foot for a fully renovated, furnished jacuzzi, whole deal, views, blah, blah, luxury penthouse, right? Like I feel this will probably at least track inflation. I've made investments in Ecuador where, I renovated an apartment in the city center in a cute town, historical town. And it ended up costing me less than $100 a square foot, right? So when I'm buying that cheap, I have a hard time believing that that it will not at least track inflation. Another way to go about it as well is just getting debt. That's a bit riskier. But if you can get some fixed rate debt at relatively low prices and put it into assets that are not insanely overvalued, that are fair valued, you'll probably do all right. And if you can lock in debt at 3% and you think inflation is going to be a lot more than that, why not? And that's high risk for sure. But that's one way to beat inflation. It's to actually play it and to play it with leverage.
Yeah.
And that's what, the powers that be are doing, really.
Speaking of leverage, and you kind of touched on this earlier, I think glossed over it. These properties that you're buying internationally, right? Like, I would imagine, I could be wrong here, but like, are you paying cash for these mostly, or are these, okay. That's mostly what I figured. Yeah. Because I figured that like leveraging, like I'm wondering if you're a non-citizen, right? You're buying in these foreign markets. Like like our banks are, if you wanted to, like, let's just say, right? Like the apartment in Medellin, if you're someone that wants to do that, if someone's listening to this and is like, oh, I'd love to do that. Is there a quick path or an easy path to getting debt in those areas, or is it okay?
And that's why real estate's so cheap, because there's no debt. The problem with real estate in Western markets, including, the US and Canada, is that it's not really real estate anymore, right? It's not a hard asset anymore. It is part hard asset, part financial asset. That's right. People are like, oh, but I can touch it. It's like, yeah, sure, you can touch it. So that's the hard aspect part. But the reality is probably 50, 60, 70% of the value of that house is linked to the fact that interest rates were low for a long time, right? And if interest rates were to just shoot up to 12%, guess what? That hard asset of yours will be worth a whole lot less But interest rates in Colombia are already at 10%. They go up to 20%. Won't make a change on my property value at all. So people just need to remember, in a lot of markets in North America, they think they have hard assets, but what they have is a mixture of hard assets and financial assets. They're hybrids.
Makes sense. Yeah, it's interesting. That it's just an interesting time right now. I think, especially in the United States with all the things that are going on in the real estate market, and it's crazy how all these extraneous economic factors are directly impacting our real estate values. What you're saying is that if rates shot up in Colombia, like real estate's going to be the same price.
Won't make a dent. If they go down, that'll change. If they go down, suddenly you got a massive catalyst. Then it's party time. You got that penthouse for like $120 a square foot will double in value really quickly. I'm not betting on it. That's not my thesis. But if it does happen, that's like a nice call option. But yeah, interest rates going up, all that, inflation, I don't care. Won't impact.
So we talked about the second citizenship, residency programs, that sort of stuff. You mentioned that there are several potential benefits to investing in international markets. Outside of that, what are some other maybe like nuggets that you can share with the audience that they might I might not even know exist, right? Like what are some other potential benefits, or are there? I don't know.
Look, I mean, I'll just start by saying that the U.S. generally is a good market because you're lucky enough that, it's such a huge country. And, even when things are going great in the U.S., there's always some small town where, I don't know, they discovered some oil well, or I don't know, they're building a factory or something where it's just booming, right? So there's always something happening in the States. So, Americans who call me and are like, I want amazing returns and, invest internationally. Sure, there are people that will promote stuff and tell you, you can make like 15% in Panama, blah, blah. That's all nonsense. The reality is, if you want high returns as an American, stay in the US and get some leverage and do it reasonably and find the right markets. That's the way. Going internationally really is about diversification. So we discussed the residencies, we discussed the citizenships, and you can get decent capital gains and cash flow and all that. Yeah, that's not an issue. Another one I'd add is access to bank accounts. Being able to have, when you own real estate in a country, typically you then have access to their bank system. So if you buy real estate in Hungary, for example, that will give you the right to open a bank account in Hungary as an American, which is not easy. So then you can have money stashed away overseas. So that would be, I think, another important benefit is access to bank accounts overseas when you invest in real estate. If you're looking for diversification, that's a good thing. If you don't care, if you think like, I'm fine, I'm all in the US, etc., God bless you.
Yeah, no, I mean, that's really interesting. And actually like, well, man, like when Silicon Valley Bank collapsed, right? So in my head, I was thinking, man, like there has to be like a better way, right? So what I'm hearing you say is like, hey, question, right? Because actually this just popped in my head. Are all of these, so like in Hungary, for example, are they federally backed? Meaning like, is there like here FDIC, if up to 250 is like federally insured. So are there like assurances or insurances like that when you're placing your money into international banks like that, or what does that look like?
It depends on the jurisdiction. And across the European Union, there is typically an insurance of 100,000 euros per bank account, which is government backed. What is it worth? I don't know. And then in other markets, it really depends. Some countries have these guarantee schemes, others don't. So for example, in Mauritius, which is an interesting little tax haven between two very high growth markets, Africa and India, with English as a native language, so you get good service. They have a semblance of an insurance, but I wouldn't really count on it. But some of these banks are very well capitalized. So according to Basel III requirements for banks, you're supposed to have a tier 1 capital ratio of at least 10, 12%. they're 28%, some of these banks. So they're almost 3 times more capitalized than what the minimum required is. So that's another way of approaching it. It's just going for banks that are well capitalized. Do you prefer to put your money in a bank that is poorly capitalized, but it has a government guarantee, which you may or may not trust? Or do you prefer to have your money in a well capitalized bank so that you minimize the risk of bad things happening in the first place? I don't have a clear answer to this. The answer is probably in between, probably a mixture of both, right?
Right. Yeah, that makes a lot of sense. And that's actually a really interesting way of framing it is if they're not well capitalized, but they got the government insurance, like as long as like you're really placing your trust in the government, which in the case of Silicon Valley Bank, I'm actually not sure what ended up happening there. I didn't follow the news, but it sounds like some people did not get all their money back, but everyone that had like less than 250 obviously did. So it's kind of interesting there, but we are running up on time, Ladislas. I did have a couple of final questions here for you. The first one, just talking about commercial real estate, right? So I know that you focused a lot on like apartments and kind of like single family kind of purchases, but in terms of like commercial real estate, right? Like I'm in hotels, so I'm always curious, like what are you seeing in terms of like international commercial real estate trends, and are there any markets and or like asset classes that you are bullish on, say over like the next 5 years outside of the US?
Look, I'm not an expert in terms of commercial real estate. What I'd say is every country is very different in terms of how to play it. Sometimes I'll just go to a country, I find the macro interesting, I'll ask myself, how do I play it? Sometimes I just end up buying stocks. Like I remember a few years ago, I went to Uzbekistan, I wanted to buy real estate. And it was a bit complicated. There was a lot of gray zones for foreign ownership, et cetera. And then I saw the local real stock market, and there were companies with no debt on their balance sheets growing at like 30, 40% a year and spitting out dividend yields of 20%. I was like, oh. So I went to buy real estate. I came back with a brokerage account. Other times I go to buy apartments and then I come back with a bunch of land. In the case of Ukraine, before the war started, I was making a bid with a group of investors on large office space because the office space was actually booming there before the war. Luckily, the war started before the deal closed, but it's very market specific. So I think in terms of trends, I would say throughout everything you think you know about the US, when you go to these emerging markets, guess what? Malls are cool. Like who goes to the mall nowadays in the US? I don't know. Our parents?
Not many people.
Right. But you go to Colombia, that's where people go. You go to Paraguay, that's cool. You go to Egypt, that's the place to be. And go to Asia, the malls are a big thing. So it's very different.
Yeah, no, that makes sense. And so, well, I would also argue that and I'm not sure if you would agree, but like commercial is like a big boys game, right? It's like it's really that next step up. And so just based on what you said earlier, which is like, if you're not boots on the ground, spending a lot of time in those markets, then you're probably just going to get the average. So in the case of like a commercial real estate play, it's probably better to like invest in like more of like if you're going to do something like that, maybe more of like a syndication or like a fund or something like that, where like that's their sole focus. It's like we're focused on this market, this asset class, because that's where they spend and like they live, eat, and breathe that market and that asset class. That's more or less what you're saying.
I agree. Commercial real estate is a lot trickier, as you know. So if you just go somewhere for a week and you hope to make a killing on commercial real estate, I mean, you're going to be sold the worst crap you can think of, and you won't see it. You'll be sold the thing with very high rental returns, but that then turns out to be a dud once the lease expires, for sure.
Yeah, 100%. Well, Ladislas, this has been like an awesome conversation. Learned a ton from you, and in traditional Gould Mine fashion, want you to leave the audience with one final Gould nugget. Take it away.
If the world is going to change as much in the next 5 years as it's changed in the past 5 years, you owe it to yourself to be diversified, because you don't know where things will go wrong.
Mm. Yeah, no, and honestly, that makes a lot of sense to me, Ladislas. I mean, I think that the key takeaway that I'm hearing right now is that international real estate investing isn't what's going to make you rich, but it's going to help you. It's going to help you stay diversified enough in the case that anything happens in any given market, right? Like you're not just like US. We're talking wherever you live. It's more of a diversification play than a get rich quick play. Which I appreciate because like, at least you're not selling snake oil, right? A lot of people would get on here and be like, oh, this is the greatest thing since sliced bread. But I think it's a very practical approach. And I really do appreciate your time, man. This has been awesome.
Thank you, Danny.
All right.